Hi, everyone, and welcome to macro and global liquidity analysis, gold, silver, and Bitcoin for November 2024, our last one for the year. Very exciting year, lots to discuss today, and it's actually been a very exciting month in particular. We're putting this presentation together really for the clients of the Ainslie Group, for everyone who's been following along. We met some of you down in Sydney just this last weekend at the Oz Crypto conference, and it was great to meet people in person to see that everyone's getting value from this. So really appreciated the feedback and the engagement there. That was great. I'm going to start off by welcoming our panel, Joe and Paul. How are you going, guys, for our last one for 2024?
Very good, Chris. Quite the way to finish the year.
Certainly has been. Joe, Bitcoin?
100%. Yeah, it's super keen to get into this one. It seems to all be happening.
It certainly is. It's all happening like as we speak. There's been a big move this morning. We'll get into lots to discuss. But first of all, this is a disclaimer I have to put in the front of everyone that before we begin, a reminder, everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. So we'll follow the same format we have been following all year, really. That big picture macro, digging into where we are in the liquidity cycle, the indicators we're looking at, what we do with gold, silver, and Bitcoin. But starting off with the big picture, when we were talking about it being a big month, it has been really quite a lot going on. When we looked at this last month, we had that green dot, and then now we're back in this blue dot early cycle, a little bit abnormal to go backwards. We were calling it earlier, but to see it actually play out is interesting. And before we get into later looking at what the assets specifically have done, this was probably the first anomaly that crossed our paths, wasn't it, Joe?
Yeah, absolutely. We thought we might have been off to the races last month when we got that green dot into expansion there. But also in terms of we've said it before, the difference between early cycle and mid cycle, it's effectively the same asset allocation. It just means that we're probably not quite as far through the cycle as we originally thought. So we've still got a fair bit of time to go, and we'll discuss when we think later in this episode when we think we're sort of looking like we're going to get to the end of that.
And Paul, when you saw that blue dot there, was that what you were expecting? Because as I said, we'd been leading into it a little bit. Like we peeked into the data a bit ahead to see that was likely to be the case that was coming. There was a revision that pushed that sort of previous data a little bit higher than we were expecting. Is that consistent with your general expectations for where we are in this stage of the cycle?
Yeah, because I guess there's two components to it, right? There's the inflation piece and the growth part of it as well. And we're seeing, as we'll talk to soon, this stuttering manufacturing versus services PMIs. We've got inflation, looking to be ticking up, but still not being overly ambitious. So it is in a bit of a dicky in between the two cycles. So not too surprising.
And looking at that specifically, we will look at that specifically in a minute. But the liquidity cycle component of that, which was indicating how high that dot was, we had seen that revision effectively higher that pushed us over the 50 line. Now, we were a little bit excited about that at the time that happened, but there's a little bit of inconsistency, which we'll get to shortly, with what we're seeing at that weekly level where liquidity is really dragging a little bit. But probably where we would expect to be at this stage of the cycle when you think about timing to go that it shouldn't really be a surprise to be breaking above the 50 here, even though it's sort of pulled back down towards that line. Joe, what's your feel towards where we are if you were to think of this in terms of time? Does this mean we're sort of past the halfway point in the rising cycle, rising part of the cycle at least?
Yeah. So first of all, we have been calling for a rise in liquidity, which would have a positive impact on assets in Q4 for quite a while now. We did go through a suboptimal liquidity period over the last couple of years where we stayed below that 50 line. So we're basically still in what we'd call a contraction period. And, that was closely linked to central banks and governments trying to squash inflation. So it's taken a little bit longer to get to that middle line. In terms of where we are now with that little dip, we've had a lot of negative liquidity impact from the dollar and the rising dollar, which has risen very quickly over the last 6 to 8 weeks, and also bond volatility due to bonds selling off. So it's not surprising that we've got that little bit of a dip there. In saying that, to continue liquidity positive, to be liquidity positive in the future, all we really need to see is either the dollar stabilize or come off, or even and as well as bonds yields start to lower, and the volatility in the bonds, being the collateral, start to lower itself as well, and that should be liquidity positive going forward.
Paul, looking at, this chart sort of just shows the layering on top of the various components. What Joe was just talking about there was really that shadow monetary base, or the collateral of the system. This big orange part, really the one that's suffering with the dollar and with that sort of strength in or weakness in bonds, but strength in the yields, isn't it?
Yeah, absolutely. And the other piece at play, which is still that that relatively small black bit down the bottom, is we've still got central banks, pretty well across the board, being pretty tight. So the big ones, Fed and PBOC, Fed stabilized, but PBOC is still on again, off again, but more off again at the moment. So and that's in the context of pretty lackluster growth. So I think they're stuck between the inflation and the economy piece. But you'd have to think that easing is the more likely scenario from here.
And Paul, do you think that's what's reflected here, that you've really got pretty much those big players, the ones holding it up? Because when you look at that chart, and we've obviously been following this every month, and we're well and truly out. Like, there's a big increasing amount of green on the chart. Is it just that the big holdouts are the ones that really matter the most, because the rest of the world seems to be rocketing ahead?
Yeah. That's. That the picture paints 1,000 words, right? So it's a very clear move. We're out of that red. We're heading into that green phase, and we've just got, as you said, a couple of big players that are just trying to hold out and balance that inflation versus growth piece.
So speaking of inflation and growth, we'll look specifically at the US. We use them as sort of the proxy to see what's going on, because they are the biggest player, really. But we saw some interesting change to the data here, because, Joe, we'd been talking about this quite a bit, this idea that services was potentially leading, and it did. It took off. We saw a big lead from that this month. Manufacturing still stalling down here. Now, obviously, when we last looked at this was before the election. We now know the outcome of that election. Do you think that paints a positive picture for what is likely to happen on the manufacturing side, at least over the next time ahead?
So the manufacturing has really been a bit of a headache for us. We've been calling for an uptick for quite a while, and it hasn't sort of played out. But exactly to your point, we've now had the election, and we know who's going to effectively control it. And Congress, for example, the Republicans are going to have the majority of the House, the Senate, and the presidency. So, a lot of legislation that they want to push through is likely going to get pushed through. And a lot of that legislation is based around being pro-business. So tax cuts, less regulation, onshoring businesses back to the US. So I think with that amount of certainty, particularly if you're in the manufacturing sector, you can start to plan over the next 4 years and start to deploy your CapEx. And you got to remember, once that starts to tick up, once that manufacturing starts to tick up, it becomes a virtuous cycle, right? So the more people that are employed, the more money gets more people in the economy who are paid, who spend money into the economy, and it just continues. So once that starts to move, and it might still take a couple of months before we see the confidence from businesses reinvesting in themselves and in new employees and infrastructure. It could take a couple of months, but I think it's going to start ticking up, sooner than we think.
We'll be right eventually if we keep saying that every month.
Yeah. I keep saying that, but
yeah, but importantly,
I think it's going to skyrocket.
Part of that survey is the forward looking. It's the sentiment piece of that survey, and that was quite positive, right? So the respondents are confident in terms of that future, and that's potentially playing out in that three 3-month leading indicator ticking up pretty positively there. But that there's the now, but there's the expectation from the respondents to that survey that it's looking a lot better soon.
Yeah, business confidence is definitely picking up from those NFIB surveys and exactly what you're talking about, Paul.
Yep.
So that would paint a picture that recession is not really on the horizon. And we've been saying that for a long time, and it doesn't look like it's here imminently, at least. The other part of that, Paul, that you were sort of alluding to before is the inflation aspect, because that together with the growth is how we sort of figure out where we are in the cycle generally. We identified earlier, really the last couple of months, that inflation was actually ticking up on our leading indicator here, which is the orange line. But we've got the reported rate stabilizing, not quite at the 2% target that was always touted by the Fed, that was what they were aiming for. If inflation is going to continue up, we've been saying that it probably is a good thing for where we are in the cycle, but because generally inflation does pick up from here. But is it problematic that we didn't get to that 2% target? Do you think the Fed just changes the rules here? Does it just, or change the objective and say, well, 2%-ish, 3% is the new 2%? Like, what's your view on the response here? Can they cut when they haven't hit their target? How do you think about that?
That's their conundrum. So quietly, they want higher than, I guess, headline inflation, because that gets rid of, or helps get rid of, some of the debt burden that they're carrying. And on the flip side, you've got the interest cost for that debt, with higher rates. So it's I'm not surprised it didn't get down to 2. And then we've got sort of forward looking. A lot of what Trump's proposing is inflationary. So we still have quite considerable pressure to the upside, I think, from here, with what's coming. So it's their dance. They're stuck between inflating away the debt and servicing that debt. So I think where it's at, I'm not terribly surprised that they didn't get down to 2.
And it's interesting to see if we notice a real change in the rhetoric around that, because if they're dancing around that line, like you said, it's been something they've been talking about for so long. When you change your tune, you have to be careful how you do that, because you could get a very negative reaction from the market, which actually leads me to the next point, the bonds, right? Like the bonds are the one that I think is the most important thing for us to be looking at the moment. We've mentioned that a few times over the course of this year, really, that we expected it to go one way and it sort of did, but now I'm not so sure. When you look over the long periods, over 30 years of government bond yields, the red line being the Fed funds rate, you can see that the expectation usually would be that once we've topped out in the Fed funds, that the yields anticipate lower rates ahead and start pulling back. So for those who don't understand how that actually works, these are inversely related to the price of bonds. So them falling meant that bonds were increasing in value, and that's all very good for liquidity, as we've talked about previously. When you zoom in and look at this at the 5-year, over the last 5 years, at the moment, it's not responding that way. We're certainly getting a counter move here. Now, I'd like to think that the smooth landing scenario is still in play and that's just going to roll over and head down, but it hasn't so far. Joe, like, what's your interpretation of that? Are you still on the side of, because when we've talked previously, you were sort of on the side that that's going to roll over. Do you still think that, or is there increasing risks that just doesn't happen and that the Fed is kind of stuck here?
Well, to your point on that previous chart where the Fed yields would usually follow the Fed funds rate, it's generally because everyone realizes that we're in a recession, right? So the Fed wants to loosen monetary policy and get lending going to boost the economy again. So at the moment, and the predicament that I suppose we and the Fed and the government are in, is that the economy is not in a recession. Therefore, they can't just cut rates aggressively like they previously would, because they're worried about inflation, right? So while the economy is still humming along quite strongly, there is a potential, I think, that that is the top for this part. Like, so we could be forming a lower high there compared to the previous. Like, that's sort of that's been my base case, and I think that, just generally speaking, because I do believe that the government wants to lower the debt cost, right? And they're happy, as Paul said, they're happy to run the inflation a little bit hotter because they can effectively make up whatever number they want when they give it their headline PC inflation out to the public. So it's very much a tightrope, but I also believe that they've got a lot of tricks in the bag. If those yields start to get out of control and they start to rise quickly, there's a lot of ways that they can bring that back down, whether it be straight up QE or, we've talked about a lot of backdoor QE policies that have been occurring since the end of 2022 to maintain the financial system. But worst case scenario is they can literally just bring back straight QE.
Yep. To
suppress those yields.
I mean, I worry that if they were to do that, it would shake confidence in the market, and you would see potentially them lose a little bit of control of the bond market here, and those yields actually head higher. Against that backdrop, I don't know. Like that's just maybe that's a bit of an overblown fear, but that's something that plays in the back of my mind. Paul, do you like what?
Well,
how do you think about it?
I don't think this reflects last night, does it? So last night we saw yields fall pretty drastically, along with gold and Bitcoin and oil and the dollar. So it was a pretty interesting night. I think the market, there's an expectation with the new Treasury Secretary nominee. He's not in, but I think there's a lot of expectation with Scott Bessent coming in that we're going to see those yields come off and a weaker dollar. So I think that's in play now as well. So last night we had a re-inversion of the yield curve. So, that's the first time that's happened since September, I think. So we've now got an expectation clearly in the market of lower rates in the future. So I think that was fairly telling as well. What that means. We've just had a steepening, and now all of a sudden we're back in inversion. So I'm not sure what that means, but but there is clearly an expectation of it falling, I think.
I think that's just a symptom of the manipulation of the curve itself that we've been seeing for a number of 12, 24 months. Whereas it's not really a free market, so the yields are being suppressed at one end and allowed to run on the other, and you get those inversions. So it's certainly something. It's very. I wouldn't want to be trading them or be trading a steepener or a flattener in regards to the bonds, but it's certainly going to be interesting to see it play out.
And I mean, I said this at the start. It's been a really interesting sort of month and quite confusing because these things technically should be headwinds, and we've had Bitcoin to all-time highs, gold to all-time highs, potentially for the wrong reasons, right? Which is where you start to get concerned about it going up, because are people just looking for the safe haven asset, being concerned about the bond market blowing up? But then when you see what happened last night and you get that sort of reverse of that, it's a little bit back to front to what you would normally expect. I think a lot of it is tied to the dollar. And that we were having a conversation about this yesterday, saying, when do you see 8 green candles in a row? Like, that's just, and these are weekly candles. You're very hard pressed to find that on these charts anywhere else. It did have a big move over that period of time, but when you sort of zoom out and look at it historically, maybe not that big. If this were to roll over here, theoretically, that's a tailwind to the market. It's certainly a tailwind to liquidity. Paul, what are the mechanics there? Like, why is it probably in everyone's best interest for a weaker dollar here?
I mean, we speak about this a lot. This debt is US dollar denominated, right? The global debt issue. So higher dollar, higher burden. So a weaker US dollar is effectively liquidity positive globally, and that's been one of the biggest headwinds that we've been talking about there, and it came off again last night. So that little red candle's got
a bit bigger.
So it's definitely one of the key things to watch, and certainly again that Scott Bessent he's on record, he wants a lower dollar. So I think
it makes sense to have a lower dollar. Like really in everyone's interest. Like the US can use a stronger dollar as a political tool for a while, but for long periods of time, it's really not going to fly, especially if, they want to onshore manufacturing and they want to be able to export those products. If the dollar's too strong, they're not going to be able to export anything because it's just too expensive.
Yeah. And it helps, part of China's dilemma is trying to, keep the yuan strong. So, it helps in that equation as well, where we might actually see them ease up a bit.
So that would be very interesting when we talk about assets shortly to see whether they revert to this environment, which should be actually quite positive for them, helping once we get past this very confusing. It was a very confusing month because the signals are sort of all over the place, and there's a lot of cross currents going on, and why things are moving the way that they are. But specifically looking at the weekly, this is probably been the one that has been causing us the most head scratching here. We understand why, but when you look at that weekly global liquidity, we were thinking that those central banks would really come to the party by now. It was certainly when we were in the lead up to that election, we were expecting more of that sort of fiscal support to come through. That didn't really happen. China's been difficult. Europe's been difficult. Is this, Joe, I'll probably go to you on this one. Is this just still one of those air pockets? We called the air pocket very well earlier in the year, where that really pulled back, and then it gained the liquidity did come roaring back. Are we in the same situation again, do you think?
Potentially, yeah. So as Paul pointed out, you've got a number of central banks and countries around the world that just aren't playing ball, and a lot of it's to do with the stronger dollar. So China, Europe's the European economy is looking fairly weak at the moment, and the euro's just getting absolutely hammered against the dollar. So they're not likely to ease while their currency is getting absolutely destroyed until the US dollar comes off. So they're stuck in a rock and a hard place as well, which is why I was saying politically, the strong dollar doesn't really going to stand with allies for very long before someone starts getting quite cranky about it, if you know what I mean. It's the same with China as well. They probably want to stimulate, but a weaker yuan is not the ideal time to be doing that. We know the yen's just been getting hammered for the last 12 months. So really, when we talk about the dollar, I know there's a lot of emphasis on it. It really does matter for things like this. And
we could see this chart just rocket from here on the back of the dollar alone, couldn't we? Like that.
Absolutely.
That could single-handedly do that.
And the other known that we've got at the moment is the TGA, right? So we know the Fed's got the debt ceiling, or US has got a debt ceiling, coming in January. We know that the TGA's got, what is it now, Joe, 700 or 800 billion?
Yeah, I think a bit under 7.
So they have to get that down to 250, right? That's the rules. So that's a lot of liquidity that we know is coming into the system over the next couple of months. So, whilst that air pocket, we knew about the air pocket before because of the tax payments pocket in the US. We probably didn't know of this one coming down because of that unexpected US dollar strength. But what we do know is the rebound. Certainly from a US point of view, just with that TGA, and then add to that what looks to be the bonds, the yields coming off, and maybe the turn of that US dollar. So there's a few things coming together that I think are positive for the next couple of months, at least, anyway.
And I'd love to return to that in a minute to think about this catching people off guard, because it really will look like the perfect time to capitulate on your position if you were sort of long the market in the assets that we're talking about, Bitcoin, gold, silver, right at that period of time where the data is about to turn. And that's what often catches people out, because they go, they start to panic and see all this negativity, see an arrow pointing down and leave, and not understand the market is going to be anticipating the move higher on that. One last thing I really want to talk about in this particular section was the US cheating is how I'm going to word it, because what we saw recently, we have talked about this before, in August, the change to the stress test rules that went on here, really there hasn't been enough liquidity in the system overall. They've been right on those lines of what are considered through a lot of research to be adequate reserves. And the danger, of course, is if it breaks through that line, you have the potential for widespread economic chaos because people can't pay. You got to have a certain amount of liquidity in the system for debtors to be able to pay. Yeah, that's how the system works. Right when it was getting below that line, suddenly the rules changed. Joe, do you think that this was actually them just trying to buy that little bit of extra time for the bonds yields to roll over, for the US dollar to roll over? Is that what they were doing there? But because this is another form of unconventional policy. It wasn't cutting interest rates. It wasn't doing the typical things you do to add liquidity to the system. It was kind of cheating.
Yeah, back to that backdoor QE to inject liquidity into markets. So, it's effectively just kicking the can down the road. And as we know, they're quite good at it. And that's, when I talk about what we were talking about the bond chart before, how if that got out of hand, what needs to be done will be done. This is just another example of the rules changing. So there can be the markets and the banks will be more flush with liquidity that can find its way into markets and into the banking system. So every time we get a little bit concerned about liquidity coming off, the rules seem to change, or there seems to be an upcoming change, which is, like I said, why I'm not generally too worried about deteriorating liquidity conditions over the next short to mid period of time.
And Paul, this isn't the first time we've seen this, is it? It's fairly standard practice to find a new way to, I don't know how you would describe it, really dress up the same old play, that you find another way to do what's necessary.
This is probably one of the more subtle attempts. I mean, I think the last time we saw the BTFP when we had the banking crisis that you've got up there, the SVB, First Public Banking Crisis. Like, again, it was just a different acronym for more money, more liquidity to save the day. This is probably a more subtle way to do it, so it's not spooking the masses, but it just highlights the irrefutable fact that when you have that much debt, right, the rules can only be changed so much. You have to feed it, you have to roll it over, you have to service it. So they can only do these sort of subtle changes so many times. But at the end of the day, you can dress up with every acronym and every dotted line, but it's more liquidity, and it must come, because the system will grind to a halt in a very disorderly way if they don't.
And that's really, at its absolute core, that is our strongest belief that keeps us solid and on the path to knowing where things are going to go, because we have that certainty that when push comes to shove, they will always act, and they always have, and they always will continue to do so. And I just loved the absolute perfection of this chart for demonstrating that, because it really just showed when they needed to, they did it. And very few commentators even would have noticed the subtlety. Like, you've got to give them credit, really. They're quite good at playing this game and hiding it from the mainstream commentators, who will say, well, we're not doing QE. It's, they're removing liquidity from the system, but there's more than one way to skin that particular cat. Yeah. So moving on to the assets, and this is where it all gets really exciting over this last month, because we've seen just some spectacular gains that we've all been hanging out for. First of all, we link global liquidity and world wealth. We know that there's that underlying driver there that makes perfect sense. We have, I'll actually pause on this chart for a little bit, because we've been arguing for a very long time that when you see this black liquidity line going up and to the right, the assets that best perform in that environment are Bitcoin and gold, because they are monetary inflation hedges. They've been doing their job, some would argue, so well that you could see that they might be getting a little bit ahead of themselves. Paul, I'll start with you on this, because my view is, yes, they possibly were getting ahead, and I'll say were because we've had a little bit of a pullback this morning, but were getting ahead of themselves. But at the same time, I just look at the angle of this line, where we've really picked up the liquidity over recent years very aggressively, which is all that debt, that's becoming exponential, and going, that kind of seems sensible to me, because there's no viable solution in place. There's no one talking about how they're going to fix that, other than saying we're going to fix it. Like, there's no actual plan around it. does it make sense for these, gold and crypto here to see that and go, well, okay, actually, let's get ahead of this thing?
Yeah, I mean, there's definitely front running going on, right? So I agree, because the math says that black line is just going to keep going and getting steeper, and it'll catch up. So, but arguably, as strong as gold's been this year, it's paled against Bitcoin over this last month. So a lot of that vertical part of that gold line is Bitcoin, and it's had other drivers, and which I'm sure Joe will speak to shortly. There's been things outside of the liquidity piece that have driven that fervor in Bitcoin. So I think there's an element of that. But as you said, Chris, that black line mathematically just has to keep going up. So it will catch up.
And when you think about just the debt, the interest on the debt, where we are currently, that's your mathematical certainty, because at the moment there's no viable way to even slow the ascent of that line. So that's the real danger, that it does go exponential. It does go pretty much straight up vertically. Joe,
I think we got to factor in, with gold in particular, we've got to factor in that front running piece could be just the safe haven part of that, of what happens inevitably when that black line sort of eyes roll back. So I think there's a part of that as well, and part of that's geopolitical as well. But so there's a number of factors driving that front run, I think.
And Joe, sort of adding to Paul's point there about Bitcoin, we know that part of the reason that the correlation isn't even higher between Bitcoin and global liquidity is the upside, when it has those big sort of exponential moves to the upside, that pull this correlation down a little bit. We've seen on the chart, on obviously this was the average price for October when we're looking at the November chart. This is now way off the chart up here. How do we think about Bitcoin in this environment? Because it's very hard to get that direct line correlation in place when you've got an asset that just moves so massively. I mean, I'll actually flip to the next chart so we can talk about it through there, because I deliberately do that here to make this a logarithmic chart, to make it a little bit easier to see what's actually going on, because it looks quite flat there. But when I flip back, this just is almost impossible to read. How do you think about Bitcoin in this environment where we really are in that big rapid growth phase?
So I think the first thing to point out is the massive move we've had in the last 3 weeks. We've had an extremely long basing pattern since March, which has allowed for this quite large technical move, you would say, because we effectively ran out of sellers. So what we really needed, which has come to light in the last 3 weeks, was a bit of a spark, a bit of a trigger, and we've had that with the election cycle and the Republicans winning by effectively a landslide. So as we know, the Republicans are a little bit more, and by a little bit I mean a lot more friendlier towards the crypto industry. For example, Trump's talking about creating a Bitcoin strategic reserve. And there's been a bill that's been submitted by Senator Lumens where she wants to propose that the US government not only buys 200,000 Bitcoin every year for 5 years, so reaching a million Bitcoin, but also hold on to the current Bitcoin that they have. So that would make them a huge player. So, that's going to drive things like that, are going to drive a lot of sentiment and large moves like that we've seen. Arguably we've had a bit of a pullback in liquidity, which has not supported the entirety of this move, which is why we're probably seeing, why we are seeing a reasonable pullback from 100 back down to 93 where we speak today.
And Paul, I mean, obviously to address this chart, right? We've got this is more up to date. This was sort of yesterday's data here with Bitcoin right up nearly at 100,000. It was sort of pushing up there. It's pulled back a little bit since. And against the backdrop of that weekly liquidity coming down, to what Joe just said, right? Like if we get a bill come through that effectively makes this asset part of the strategic reserve of the United States. You would imagine many other countries follow that. Very hard to predict what happens with price in that environment. We still, to Joe's point, saying, well, without the liquidity backdrop supporting it, you're going to get that volatility because it's sort of being built up a lot on just speculation. But we've seen speculation be able to drive these markets a long way. And it seems like the environment's right for it. I mean, I'm getting very FOMO just with the thought of that bill and what it means for other countries as well. How do you think about how far the potential is for the speculation side of this to go beyond the underlying fundamental of the liquidity?
There's a timing element of that. I mean, absolutely. If that bill passes, like for context for maybe people new to the space, like if you're talking about 1 million Bitcoin derives its value through scarcity, just like gold. So if there's 21 ever, right, and reports of only maybe 17 or something that's not lost, 1 million in that is absolutely massive. And when you're telegraphing it to the point where you're going to buy so much every year for 5 years, if you're a big sovereign player, that a la China or someone like that, you could just front run that. So you could buy. There could be an enormous run towards Bitcoin by sovereign states if Bitcoin is seen to be something that's going to be part of reserve assets. And don't forget, a lot of what's driven gold price is central banks buying up gold as a decentralized asset when they fear the weaponization of the US dollar. Okay, so Bitcoin is another perfect decentralized asset so once one moves, and discounting El Salvador and minor players like that preceding, I don't know how you quantify it. I don't know how you put a price to that, because it could be massive. Now that's maybe a next year. That's a first 100-day of the Trump regime story. So in between now and then, when you look at that chart, knowing that orange line will tick up with the sort of stuff we've spoken about already with the TGA and yields in the US dollar, you could still expect a Bitcoin retracement down to the mid 80s, and not sort of blink or get too upset about it. So given that scale, so beyond that, throwing in the rest, I just don't know, Chris, because that's a game changer. So you get a step change. You still have the forces of liquidity after that, but maybe you've got a new base. It just reprices to a new base.
And I think what you said about timing, and Joe, I'll just get you to follow up on this, but I think what you said about timing there is really interesting to me, because I can see a scenario where the timing, so the liquidity, everything supporting that is all lined up to push that to highs really possibly quite soon, early into next year. But when we get to the peak of that liquidity cycle, if that lines up with that peak speculation, like as you said, we could be at a new base, but the pullback from that base could be very similar to what we've seen in the past, massive pullback, over 50% type of pullback, that people right now would say, well, you're not going to have a 50% pullback if it's a strategic asset in the strategic reserve. But that entirely depends on how big the speculative run-up is to identifying what the true value is, particularly if we're in a end of liquidity cycle sort of rolling over environment. Joe, what's your view on that?
I was about to say exactly the same thing. We could get to the point within Q1 next year, if something like this passes, where the speculation just drives the price that far and that high, that you end up getting a huge correction simply because liquidity doesn't support it. Because at the end of the day, that's a narrative as well. Like, even though they're going to buy 200,000 a year for 5 years, that's still 5 years is a long time. So that doesn't mean that the purchase of 200,000 Bitcoin next year, if Bitcoin's $500,000, there's not going to be a whole heap of sellers. There's going to be more than 200,000 Bitcoin sold into the market if Bitcoin's $200,000, $300,000, $400,000 by into Q1. So I think there's a real potential for that to happen. Use that big blow off top early.
And we've got sort of our indicators here. I don't know how to read this particular cycle, because normally you would be expecting it, when we use this sort of 60-day cycle framework, you'd be expecting a right translated cycle, which means the high is still to come between now and the end of the year, which is quite possible. Like we got very, very, very close to the 100,000. Some would argue, I'm probably on that side as well, that this pullback that we're experiencing currently is actually very positive for this rally, because it just pulls a little bit of speculation out in what has been already a spectacular move. But people get caught on the other side of that, thinking the top's in. We probably don't think the top's in because of where we are in the liquidity cycle. But you can see a scenario where that heads higher, or that might be the peak and it's a left translated cycle for the 60 days and we head back down. I think Paul mentioned mid-80s. That number actually lines up here with this clustering chart that we use. Again, we don't trade around this or put any specific value on it, but it's interesting because what this is showing is that we've got a lot of speculators in the market who are going to be liquidated if the price gets down to that sort of level, which always operates like a bit of a magnet to the price, because the traders like to hit liquidity zones and wipe out other traders. That's sort of the game they're playing. When you look, we've been in really no man's land for a long period of time here because there hasn't been history. It hasn't spent a lot of time. It's all brand new territory. It hasn't spent a lot of time in there for people to build up positions. So, Paul, your target down here, like, makes a little bit of sense to me, at least, that could be the area we head back down to. I wouldn't be betting on it though.
No, it's no, all bets are off at the moment. It could, because the allure of that 100 as well. But then you don't know what happens at the 100. When you look at that chart, you would think it's gonna tick above it and wipe those ones out up there. But it's a very, very, there's too many factors at play at the moment on this short term. So again, we concentrate on the long term, and we're still constructive from a liquidity cycle point of view. In the short term, let's just remember, this is November we're looking at, right? 1 month.
Yes.
So it's absolutely extraordinary gains, and it would be healthy to see that retracement. But if it gets down to those mid-80s, I think the bounce off that will be very strong.
And I completely agree. There's nothing to indicate that we are at the end of that cycle, and that you wouldn't take advantage of that. Moving on to gold, which has also been, it's sort of dwarfed in this last month because of what's happened with Bitcoin. But gold has just had such a spectacular year. We've seen all-time high hit after all-time high, and then even the pullbacks have been very shallow. We're at, I mean, this is the average over the last month, but it's just been a wonderful run, hasn't it?
Yeah, it has, and it's been broad-based, which has been nice. We've had this head-scratching lead up where one of the biggest players in the room, the ETFs, have been absent, right? So, but in that last period, we've seen them back with force. So 95 ton or something, I think, of gold. So and the central bank's actually softening a little bit as well. So it's a nice broader market that's supporting this price. We did see that come off post-election, which was a bit of buy the rumor, sell the fact kind of healthy pullback in the market. Last night, it's already bouncing off. Last night was pretty heavy. It came off 3%, but that was off the back of oil, US dollar. It was across the board. So that was a Israel-Lebanon ceasefire play that in a space that's not been sticky in terms of those sorts of agreements. So it's a pretty brave move to think everything's awesome again. I'm still very constructive on gold, because again, as we look at the new Trump administration and the new Treasury Secretary, I think we're looking at a pretty constructive environment for gold going forward.
Silver also has been performing really well. I however, have loved the fact that it's been lagging, because I think I mentioned this last time. Really, the next chart's the one I like to dwell on. The gold-silver ratio has just been sitting up above this. Like at the moment, I think it's 86 point something, where that means 86 ounces of silver to purchase 1 ounce of gold. And it's ever since it's popped into my head, and Paul, you've been an influence on that as well, that it does mean revert over time. You would be expecting, we may not get right back down to the lows, although you constantly pick up on this chart that it did go lower in 2011, but the points I've plotted are just where it was at the start of the year, but got down to 12 or 13 or something, like a massive change. It's just such a once in a, this is a 100-year chart, right? Once in a lifetime type of trade setup where you can be holding an asset that you don't have to think about the dollars. If you're interested in gold and you can see the long-term future for gold, you have an asset where you can end up with more gold by just having a little bit of a timing mechanism going on here. And while it's above 80, that's my sort of line in the sand. While it's above 80, I'm saying it doesn't make sense for me to buy gold. It makes sense to buy silver. Talk our audience through that, because I could go on about it all day.
It's math. It's a reversion of the mean. And when we're sitting at 86 or whatever we are today, but it's you have to think of where you are in the market. So silver is a late cycle rally ordinarily. As we started right at the beginning, when you asked Joey where we're at, where you would say we're in the final third, okay, of this cycle. So we're ripe in silver's sweet spot at the beginning of it, but we're, as you would expect, at 86 to 1. So you have a culmination of a few things at the moment, of a high GSR, getting into late cycle, and then also just silver's properties and the fundamentals of silver that aren't always there but are reflected. That going forward we have a 5-year deficit of supply of silver. So there's just a number of things that are coming together that are pretty constructive in my mind for silver.
Well, as I've said, I'm sold, so I'll continue my silver stacking for the time being, and see how my opinion changes when we get below that 80 level. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Okay, so now we have been doing this all year, providing our simple trading plan, which is really just giving people an indication of what we would do, or what we have done personally, where we buy sort of at the low of that global liquidity cycle into Bitcoin, sell at the high of that cycle, which we haven't reached yet. But really, we just build conviction through everything that we're doing, through the analysis that we're doing, to say, yes, that low is in place, yes, that high is in place, and then we purchase and sell accordingly. Now, the low was in October 2022. The buy was January 10th, 2023. You can trace that back. We've been publishing that the whole time. See, that's what we did. And it has just been an absolutely spectacular run. Even with this little pullback and the data today, the numbers just boggle the mind. So that purchase price was $17,179 US. Current gain 441.6% over 686 days, which is annualized at 235%. There's just no asset quite like it. Even after a pullback day, you sometimes got to zoom out and look at those numbers and go, okay, well, you're still doing pretty well. So that's our sort of view on that, and we'll continue to hold that position, and we'll certainly let you know when that sell is in, but we're not expecting that, as you've seen today, for a little while just yet. So that brings us to the end for our analysis part, at least for this month and also for the year. We won't be putting one out in December, but we will be back in January. So probably the right time to do our little bit of a, maybe we'll call it a year in review / year ahead, what we're expecting for 2025, what probably the highlight of this year was. I'll start off because I can steal all the good ones then. So for me, the highlight of this year was absolutely just seeing that play out of a really challenging environment where it was just sideways for months and months and months, and then seeing towards the end of this year that rally that we'd been talking about and really trying to back ourselves on play out it was absolutely the highlight. And I think my expectation for next year is that we see a little bit more of the same early in the year. I'm not quite sure where that top will be, but quite possibly somewhere in there next year. So we'll need to keep paying attention and doing what we do to really nail that. But I'm quite optimistic, at least for the start of this year. Currently, Joe, I'll hand over to you for your wrap up.
You did take all the good bits.
Yeah, I know. That's why I did it first.
And no warning at all, Joey.
Nice. I'll speak to Bitcoin. I'll let Paul speak to the gold and silver. But I think the highlight of the year was, I'll reinforce, just maintaining our conviction throughout the whole year, particularly when, you know, people were calling double tops at 70,000 or 74,000, and then we stuck to our guns. And you know, you'd said last year, well, we did the ETF was maybe coming this time last year. We ended up getting an ETF, and now we've got a pro Bitcoin government, which is going to put us in good stead over the next 4 years. Even though it'll be a volatile 4 years, but certainly looking forward to the first quarter of next year, and and covering the price action and then the data through our episodes with the audience.
Paul?
So from, I guess, from my point of view, it's obviously been a stellar year for gold and silver, but and I think that's really, at the end of the day, a growing awareness, even at a sovereign level, right? So where we've had these central banks buying up, just a growing awareness or growing reconciliation of the perverse nature of the extent of the debt situation in the world, and that there is only one game in town now, and that is fiscal dominance over monetary dominance, and really the need for liquidity to keep the patient alive, and just go back to Exhibit A of monetary inflation versus gold and silver and Bitcoin, and you can't unsee that, right? So, and that's, I think there's been a much broader adoption because of people, you know, finally getting what's happening. But it's also taught us that there's no simple, beautiful sine wave of these sorts of cycles. They have many working components, and I guess we've watched China be a huge influence in that this year, as they try and find their way in this world as well. So it's a very interesting time, and next year is going to be a big year. So next year we will see the top, and we'll see us hitting that wall of debt that's coming. So debt refinancing. So it's as interesting as this year was. Strap yourself in for next year, and we'll do our best to predict what comes next.
Well, you heard it here first. That top's coming next year. Paul just said it there, so we'll bring this episode back up when we need that. Thank you both so much for everything this year. It's been great, and as I said at the start, we got some feedback from people who came up, and I really appreciate that, to say, oh, we're watching that, and just keep that going, because it's really helping us to understand, with your consistency going through the markets the way that you do each month, is helping us to understand what's going on. So we hope we can continue to provide that for you next year. A big year planned, lots happening. You know, who knows where we'll be by this time in January, looking back at it all, but all very exciting. So wishing everyone a safe and festive holiday season, and we look forward to seeing you all then. We'll chat then.
Cheers, guys.
Yeah.